Let's do it, folks. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. It is Monday, the 5th of December. I'm your host, JD Durkin. Opening bell rung just moments ago here on the floor by P10. This to celebrate the company's first anniversary of its listing on the NYSE. Taking a look at where the major averages stand. I'm just going to pick my head up and look. The Dow is down 0.6. The S&P is down 0.6. Similar story across the major indexes as we trade down slightly into the red to kick things off. As you know, the advantage to being down here is when I don't have the numbers in front of me, they're right up there on the board. They give it to us here at the floor. It's nice. Here as we kick off the trading week, as Wall Street comes off its second positive week in a row. This coming week, investors are looking ahead to more economic data, as always, ahead of the Fed's December meeting coming up on the 14th. Taking a look at what is on tap for this morning's broadcast, we will talk China as the world's second largest economy begins to ease its notoriously strict COVID policies. This will be welcomed news by many. Plus, we will be breaking down what exactly is going on with Tesla as the EV giant slashes output in one of its biggest markets. Kind of deals with the last story. And finally, we'll take a closer look at how Netflix is faring just about 1 month into its new ad-supported tier. I do wonder how that's working. For more on those stories and so much more, we now bring in our senior editor, our markets correspondent, our Blueberry Bagel correspondent, our chief Miami Dolphins correspondent, Martin Baccardax. I'm going to continue to give you titles as we roll week to week with the show. Good morning. Hope you had a great weekend. I don't always like to begin the show, Martin, by looking backwards needlessly, but I would like to get your gauge on Friday's session if you're willing to revisit it, because it did see this late day rally, and I was kind of wondering what the 3 o'clock hour would bring, and we did have the rally that some expected. This after the hotter than expected November jobs report. It was kind of a tale of two different trading days there. I think it kind of speaks to a little bit of confidence that investors have to kind of shake off what happened Friday morning. What was your take then that led us into the weekend?
Yeah, it was a confusing session. There's no question about it. I think your assumption is absolutely correct in seeing that we had that hotter than expected, at least wage gains that were embedded inside of the jobs report that gave markets a bit of a spook. And, perhaps the thought process was they were going to ignite a change in the Fed's thinking with respect to not only near-term interest rate hikes, but also where they might go into the first months of next year. But when that began to sort of find a challenge, both in the bond markets and in the sort of second and third readings of that jobs data, I think people understood that from a private sector point of view, it was the weakest edition since April. Since April of 2021. In fact, so the resiliency of the job market may not be reflected in the number that we saw on Friday. No one anticipates that the wage gains will continue to accelerate into the end of the year and beyond as demand for labor starts to fade a bit as a result of headwinds that we're seeing in other parts of the economy. And indeed, the fact that the bond market has been flashing recession warning signs for a number of months now, all of that sort of collectivized to temper the at least assumption that the Fed would have to get more hawkish as a result of these numbers. So in essence, JD, it was seen as slightly more of a one-off than a developing trend. We didn't see a big change in Fed rate hike assumptions for December, although they did inch a little bit higher into the month of February. But we're largely where we expect to be when we arrive in the spring of 2023 with a terminal rate of around 5 to 5.25%.
And to that point, Martin, I really got to give you a lot of credit. I feel like you have really set us up for success because you've been saying this for quite some time, that maybe sometimes it matters less what the incremental change is and much more about that terminal rate. So it sounds to me as if you're saying December maybe not necessarily have adjusted one way or the other, but in terms of the terminal rate or the final rate when they're done with the campaign, it's going to be higher, and that the Fed is going to keep rates at that elevated level for longer. Is that a fair read of things?
I think for the most part, yes. Now, what's happening, JD, at least in my interpretation, is that the market is setting aside their previous fixation on near-term changes in the Fed funds rate and focused not only on that terminal rate, but to what you alluded to, and that's the time frame in which it will stay at that elevated level. Now, that is going to be challenged by a number of things. First and foremost will be whether or not the U.S. slips into recession next year. If the recession is shallow, the Fed can probably hold at that level for at least a period of time and not inflict further damage onto a weakening economy. If the recession, and if indeed it comes, turns out to be deeper than anticipated, I believe the Fed will have a very difficult time articulating the need to keep rates elevated whilst inflation is slowing and the economy has slipped into contraction. Therefore, I think that they will end up having to alter their language at the very least in the second half of next year, and potentially even begin talk of rate cuts if indeed that recession were to prove to be a little bit more severe than anticipated. Obviously, all of these mechanics are a long way off now, but for the most part, I do think that the market has neutralized near-term moves with respect to Fed rate hikes. They're now looking at a couple of different mechanics. The first and foremost being what the bond market is saying about potential recession, and secondarily, what companies are saying about their forward earnings projections. We're at the end of the third quarter earnings season right now. When you strip out the energy sector, collective S&P 500 earnings fell when compared to last year by about 3.5%. They're going to fall even further over the final months of this year. So we'll see what companies have to say about that. And then again, most importantly, how they anticipate earnings growth into 2023. That's going to be the big story going forward, I think, JD. Company earnings and the separation of those that can pass on inflation increases and drive margin improvement in a weakening economy. It's going to mean quality names over the previous growth ones. And that, of course, has big arithmetic changes for how the indices perform.
The bad news, Martin, is that it's Monday. The good news is perhaps there is new economic data to look forward to in this trading week. I'm always looking for the silver lining. What are you following, and what should our viewers be paying attention to in the days ahead?
It's a reasonably light week, actually, JD. I think the big number that we're going to be focused on will be November inflation, which will come next week. But we'll get some producer price inflation data on Friday. A number that I think is going to be interesting and perhaps more important than it typically is the University of Michigan's Consumer Sentiment Survey, which will come Friday as well, because I think ultimately consumer confidence is going to play such an enormous role in earnings generation and indeed in the services portion of the economy, which is about 2/3 of economic growth. So we'll look to that. We'll look to what that survey is saying about inflation expectations, which I also will think prove to be important. And maybe as well, JD, I'm going to be focused on trade numbers this week. We'll get October trade data. We'll see what kind of drag that could have on GDP growth if we see, as anticipated, the global trade deficit for the U.S. economy rise to about $80 billion over the month.
Yeah, of course, the University of Michigan Consumer Sentiment Survey is better than the Purdue Consumer Sentiment Survey. That's a college football joke. Don't worry about it, folks. Easily, by the way, by a big time score of 43-22. Wow, we can talk first. We could talk more sports later there in the big house. As we kick off here, what really is, of course, the final month of the year. From time to time, we talk about that Santa Claus rally that oftentimes happens around December 22nd for the following week. What do you think are some of the biggest risks, however, Martin, facing markets as we wind up 2022, what a year it has been, as we head into 2023? Are there things that you are paying attention to that you think maybe a lot of average investors aren't paying attention to, and maybe they should be?
Well, it gets tricky in this time of year, JD. There's no question about it. Although the market has had a decent recovery since its summer lull. In fact, on a quarter-to-date perspective, the S&P 500, I think we're up about 13.6%. We're essentially flat to last week, so some of that enthusiasm is fading a bit. So there are questions as to whether this sort of mini rally is going to extend into the end of the year. But you have a bunch of factors to consider. Certainly, fund managers are going to be reluctant to extend a great deal of risk amid the global economic uncertainty. And of course, with a Fed decision coming up in mid-December, they may be willing to sit on their hands and protect what meager profits they've been able to generate in a really difficult year. If that's the case, we're probably going to see lower volatility, lower liquidity, and therefore less of a chance for markets to sort of creep up into the end of the year. Obviously, the Fed wildcard is out there. It can't be denied, particularly if there's language after the December 15 decision that would indicate a hawkish tenor into 2023. And clearly, we have to be looking at, of course, the economic headwinds that come from China, that come from Europe, and that come from elsewhere. So I think ultimately, I'm not entirely certain that we are looking at a situation where this rally can extend with full might into the end of the year. I think investors are going to want a bit more clarity on the earnings situation. They're not going to get that until early January when we start to hear from the banks, and then this whole earnings cycle repeats itself as it does every quarter. So my anticipation is that we might drift modestly upwards between now and the end of the year, get a bit of a bump in the post-Christmas trading, but it won't be anything significant. If we're there or thereabouts levels that we see today, I wouldn't be terribly surprised.
I do want to get your perspective on the strength of the U.S. dollar, or maybe right now a little bit of the lack thereof. Obviously, we know what the story has been now for several months. We are starting to see the pullback. One headline says U.S. dollar is on pace now for the largest monthly loss since 2010. A little bit of, whiplash maybe for people that are trying to follow. What is behind the latest, and what is the impact? I know there's many impacts, especially as we cover the price, and we cover WTI and Brent and what that means for gas around the world, and that's just one part of it. But what should people know with regards to the greenback?
Well, it's weaker again this morning. I think it was down about 1.5% over the month of November, if I'm not wrong. But indeed, that is certainly a big change with respect to what we were talking about really only in the last part of September and early October. But once Fed rate hike assumptions began to change, and we heard the first dovish hints from Fed governors, which were, of course, clarified by remarks last week from Chairman Jerome Powell, you could see the steam being taken out of the dollar trade. The dollar, for the most part, is going to move on interest rate differentials. It is seen as the price of money, and in global markets, the US dollar is a benchmark for money. It's also worth noting, though, that the US dollar index, which tracks the greenback against a basket of 6 global currencies, is also seen as a mechanic in which investors can express bullish or bearish sentiment. So in other words, they tend to sell the dollar down when they're feeling a bit more optimistic. They tend to pile into it when they're feeling a bit more pessimistic. That's not a binary trade, but for the most part, it's proven to be true for the bulk of this year. So what we're seeing now is a bit more enthusiasm for other currencies, and that has, of course, pulled down the US dollar index as a result. There are fading bets on Federal Reserve rate hikes, or at least the jumbo ones that we experienced earlier this year. That's also pulling down the value of the dollar. And we're seeing a defensive bid for Treasury bonds, which lifts prices and lowers yields. The lower yields act as a magnet to the US dollar and pull it lower as a result. So those collective sort of mechanics, if you will, JD, are a big part of the reason we're seeing the pullback in the dollar. It's good news for American exporters. It makes their goods look more attractive in global markets. It's excellent news for developing economies because their food and energy imports become cheaper at the same time. What you don't want is a dollar that's in terminal decline, but you don't want it in terminal ascent either. You want a sweet spot that solidifies the strength of the greenback whilst at the same time doesn't choke off growth in this economy or elsewhere. We may be moving towards that level sometime next year.
Certainly easier said than done. I do want to ask you about a big story overseas, because it's a big story domestically as well. A bit of optimism, dare I say, over China's reopening plans. What do we know so far?
It was a quiet bit of reopening news, wasn't it, over the weekend? There was reports coming from some major cities, Shanghai being the most significant, that they're pulling back on some of their prior COVID restrictions, the most important being the requirement for a negative COVID test whilst somebody is trying to use public transportation. That, of course, has gummed up the system for a number of months now, and essentially just meant that people who do test positive have been unable to travel. So there's a certain optic element to lifting that restriction, but at the same time, it's an important one when put into the collective of changes that we've seen over the past 7 to 10 days, most of them coming after public demonstrations as a result of just frustration over these long zero COVID policies. No major change has been announced, and indeed most of these changes have just been quietly implemented rather than trumpeted by the ruling government in Beijing, and I do find that interesting. But they're welcome nonetheless, and we're seeing stocks bounce as a result of it. Western markets have been a little bit more, shall we say, pessimistic. That's not the right word. They've been more in a show me mood with respect to the changes in China COVID dynamics. They're not buying it just yet. but it is incrementally positive. That's why we got the gains in overnight trading. They faded a bit into the start of our session, but it will absolutely be something that they're tracking very closely into the end of the year, and indeed into the Chinese New Year celebrations, which will be upon us very soon, and of course are the biggest travel period of the year in that massive economy. It will be interesting for me to see whether or not those COVID restrictions are in place going into the Chinese New Year, or whether indeed the government is brave enough to pull them back. That will be probably the most important signal that we'll see in the near term.
Martin, people will certainly wonder, well, I saw all these headlines, I saw the footage of these protests. It is for people wondering whether or not that is at all part of the calculus there for the country to change what it has been doing, what many people would say, change what has not been working. Do we know the why behind the shift?
I don't think we do. I think there's a great deal of speculation with respect to whether or not Beijing was moved by those protests. You'd have to think that it played at least a factor in their decision to loosen some of these restrictions, which again are just only marginal changes and not really anything of great significance. They haven't reopened the economy to any meaningful degree, but nonetheless, they're welcome changes. But what I think has happened is that China's ruling government has understood this. It's one thing to have domestic protests in an economy that's growing, creating jobs and generating wealth. It's another thing to have those protests in an economy that's shrinking, where unemployment is rising and where spending power is becoming debilitated. And that is the condition that we see in the Chinese economy at present. It's just too much of a risk for the Communist Party to take, to have civil disobedience set against economic decline. That is just a recipe for revolution. It's not something that the government is prepared to countenance. So they may be making the calculation that easing some restrictions, creating an optic of progress whilst they mend the economy and the damage that their policies have done, is probably the best course of action.
I gotta say, I really like the phrase "recipe for revolution." I don't know if it's a band name. I don't know if it's what we're gonna call the show. I don't know what it is, but it just rolls off the tongue. I like it. I wrote it down because I don't want to forget it. Morgan Stanley upgraded China stocks. Oh yeah, go ahead.
No, it's worth, JD, because I think you're catching on to that phrase is interesting, because if you go back to the Arab Spring in 2010, it's interesting to note that a big portion of the civil uprisings that we saw over that period were the result of some really innocuous developments. For the most part, it was about an increase in food prices. In one case, or in a couple of cases, a really significant increase in cooking oil prices, things that you wouldn't necessarily have assumed would be the sort of the touch paper for that kind of social change, but they absolutely were. And of course, they lit across the whole of the Arab world for much of 2010 and elicited really significant political change. So if they can occur in very innocuous situations like that and spread very quickly, they have the enormous potential for change. And I think this is probably why the Chinese government was so mindful of even those small protests and what they could do in a weakening economy.
And I certainly remember, as do probably a lot of our viewers and you as well, how important Twitter was as a platform with regards to the Arab Spring. And that ties in with a whole other host of conversations that we are still having with regards to that platform's role as the so-called digital town square, both in terms of its impact here as well in other countries as well. That's a great point there, Martin. I do want to ask you specifically about how banks are viewing the China issue. Morgan Stanley upgraded China stocks on hopes of a reopening here after the last few years, the reopening, the likes of which we were just discussing. Do you expect to see other big banks, other big names in the financial world begin to change their tune on China? I've gotten the sense that a lot of them want to be very bullish in their sentiment in terms of future of investments, but they have not really been able to very much, given China's approach up until now. Is that starting to change, I wonder?
I'd like to think so, and I certainly hope so. I think an expanding Chinese economy is good for all of us. Obviously, we can draw a straight line between political and civil freedoms and expansion of economic growth. I don't know that that argument has particularly successful rebuttals. So at least if you're looking at the human element of the China population, which is I hesitate to use the word suffering, but nonetheless is certainly working within the conditions of an autocratic communist party. If we're looking at the human condition there, stronger economic growth, generation of wealth, the addition of jobs, and the expansion of activity is all very good news because political freedoms tend to follow. They don't always follow A to B, and it's not always a short time frame, but they do tend to follow. So it's good news from that point of view. It's good news from the global economic point of view as well, because if for no other reason, China is the second largest economy in the world, and it is the engine of export growth for economies all across the planet. Most importantly here, China, of course, exports deflation to most of the world. Its goods are produced more cheaply there. When they are sold to advanced economies, it lowers the price and therefore lowers inflation dynamics. It's even more important for America, JD, because China is such an enormous holder of U.S. Treasury bonds. They purchase those Treasury bonds as the result of trade surpluses that they have with the United States. The more that China can produce and sell into the United States, the more Treasury bonds they're going to buy. That holds down yields, holds down government borrowing costs, gives governments the chance to cut taxes and increase spending as a result of those reduced borrowing costs. So the follow-on effects of a surging and thriving China economy are good for the entire world. And I would add, as I've sort of articulated, they're also good for the Chinese people as well. So I'm hopeful that the banks are seeing something bullish because everyone will benefit as a result.
Martin, I want to get your take on the Tesla side of this, and it's not entirely unrelated to the parts of the conversation you and I were just having. On the one hand, the company delivered more than 100,000 China-made EVs last month. That's the good news on the production side of things. Yet, according to reports, Tesla also slashed output by 20%, if I'm not mistaken, specifically at the Shanghai plant. How do we square those two seemingly conflicting data points, where some of it's positive and some of it is maybe causing a bit of concern to people?
Yeah, Tesla's having to navigate that difficulty pretty much as everyone else, and they're having to do it on the fly. It's worth noting, JD, that Tesla China has said that the reports of these production cuts over the month of December are not true, although they specifically didn't say which portions of the reporting isn't true. The reporting said the production is going to be cut by about 20% from November levels because they're concerned about demand in the biggest EV car market. Now, again, Tesla China says it isn't true, but that could mean that they're only going to cut by 15% or potentially by 25%. So we don't know the full implications of the reporting, and we'll get further detail as we track the story in the days ahead. But the difference between what we're seeing then and what we saw in November, I think, is largely a result of price cuts. We reported back in October that Tesla was looking and actually executed significant price cuts on both the Model S and the Model Ys in China because there's fading demand and increased competition. So the result was that they actually shifted this record amount of cars in the month of November, 102,000, up about 90% from last year, but they're doing it at thinner profit margins. And that, of course, is going to have implications for earnings growth. Tesla might feel that it just wants to maintain its market share in China, and I can understand that completely. And they may only want to do it until they ramp up production in Brazil and Austin. But those challenges are multifaceted, and Tesla was left, at least from its point of view, with no other course but to cut prices and hold them down at these lower levels, whilst at the same time they're raising prices here in the United States. So I thought that was the interesting dynamic in the numbers that we saw in November and the production cuts that we're seeing in December. And then underneath that, JD, there is another component, and that is competition. BYD, which is the biggest per share car maker in China, they sold about 229,000 cars over the month of November, so more than double Tesla's tally and significantly higher in percentage terms on a growth basis as well. So Tesla's not alone anymore in the EV market in China, and many investors will say that dynamic is going to be replicated in Europe and the United States in the coming years as well.
It's the first time the company has had to voluntarily, and that's the key word, reduce production at its Shanghai center. Year to date here stateside, the stock is down 53%, currently trading at 186. I know we got viewers who remember once upon a time, not that long ago, it was significantly higher. Is the company in trouble? Is Tesla in trouble, or are reports of its demise greatly, if not at least somewhat exaggerated?
It's not in trouble. I really don't think, although the valuation is going to absolutely have to be recalibrated by investors who saw it as a standalone entity in the EV car space that was going to be able to expand margins, expand market share, and expand deliveries on a quarter-by-quarter basis. And I don't see that as realistic. It's an expensive stock at the best of times, and now it's facing competition, it's facing narrowing margins, and it's facing demand headwinds. So that makes that valuation even less attractive. So therefore, you're seeing the compression in valuation, which is pulling down the share price. And of course, at the same time, we can't ignore the fact that we have Elon Musk, who is basically Tesla, is the face of Tesla, and for the most part is the zeitgeist behind the stock's gains, being distracted by his acquisition of Twitter and indeed his executive roles in other companies. And he's been selling shares for most of the year to meet tax liabilities and to pay for the $44 billion Twitter acquisition. That's been a heavy burden for Tesla shareholders to bear at the same time. All of this is going to shake out in the near term. There's no question. It's still the global EV leader, still the most valuable car maker in the world, and they still have a way to capture their investor imagination that no other car maker has been able to do really since Ford and GM in the 1960s. So I don't see it as a company in trouble, but I do think it's a company whose share price is going to have to be reset by investors and therefore perform in a new reality. And that reality is very different from the meteoric gains that we saw heading into 2020.
Of course, the company still has the seventh largest market cap in the world. Yes, 7. Shares of the company are facing what you call, if I'm not mistaken, the Twitter effect. Martin, what is the Twitter effect?
I think it is that distraction that we've so often talked about, JD, with respect to his ownership of Twitter, his efforts to get it monetized and to make sure that he can pay back the investor base, which helped him fund that $44 billion acquisition. By all accounts that we can see, at least in public commentary, he's far more interested in what's happening at Twitter than he is with what's happening at the car maker that made him rich in the first place. That's not for me to judge. That's ultimately for investors to decide whether that's an important prioritization of his, of course, decreasing amount of free time. But the effect has been played out in the shares. It's been mentioned by a number of analysts who see it as a difficult overhang for shareholders heading into next year. And as a result, that can't be ignored as a burden on the price, and part of the reason that it's had such a poor year-to-date performance.
Electric vehicle tax credits are set to take center stage, Martin, at today's EU-US trade meeting. There we go. Why is this so significant?
It's an interesting dynamic, actually, because the Inflation Reduction Act, at least part of it, has tax credits that are allocated to the purchase of electric vehicles. That's all very sensible policy. But whenever there's policies that the government creates in order to support certain sectors of the economy, trade partners get nervous because they see it as unfair competition. So this will form a central part of negotiations between the EU and the United States, who've been trying to hammer out an agreement since the Trump administration and the back and forth tariff wars that we saw over the summers of 17, 18, and 2019 as well. The essential argument is that it is an unfair subsidy to car makers, and therefore it makes the competing products from European car makers less attractive. I very much doubt it's going to be pulled back. The EU might see their opportunity to give their own subsidies as a result of sort of mechanics within the 27-member European Union, but I don't think they're going to get very far with the Biden administration to pull those tax credits out, because they form such an important plank of the Inflation Reduction Act.
Yeah, absolutely. Okay, time now for our rapid fire section for a few more topics to run through here before we finish off the morning show. First up, let's talk Netflix, Martin. Is the company's new ad-supported plan bringing in new subscribers? Is this working?
About itself having 15 million next year and upwards of 40 million by the end of 2024. That's really significant growth. Reed Hastings himself said that Netflix probably waited a bit too long to launch this service. They were against ads for the longest time, but of course they lost, I think it was about 9 million subscribers over the first half of this year, and that really concentrated minds at the top level of that company. But the December numbers say that they're adding subs at a rate that was much quicker than and will continue to carry on into 2024. 23 and beyond. So it's been an important move for Netflix, and we'll see how it plays out both in revenue and earnings generation.
All right, number two, there's a new OPEC output agreement. What will it mean for oil prices?
Well, they certainly seem to be bouncing this morning, JD. OPEC over the weekend, they had a virtual meeting, and essentially they came to the conclusion that they don't need to make any change to their October agreement. And that was one that said they're going to take 2 million barrels out of the market each day from November until the end of 2023. They want to rebalance markets because they're concerned about the demand equation, particularly in China, but also elsewhere. But I think most analysts understand that this is a reaction to the cap that was put on Russian crude exports over the weekend by the EU in agreement with G7 countries and indeed Australia as well. It basically caps Russian export sales at $60 a barrel, and that was intended to pull global oil prices lower. The fact that OPEC said, well, we're just going to stick with those 2 million per day cuts, that probably bounced oil prices as a result, and then they got a second kick from the China reopening equation. So we're moving higher. This may have some near-term implications for U.S. gas prices, but much will depend on how China develops into the coming sort of quarter of 2023. That sub $3 U.S. gas price forecast, however, JD, I think might be in peril as a result.
Third and final, Sam Bankman-Fried says he'll face Congress. Maybe? I don't know. What do you make of this?
On his own time frame. It's just another extraordinary weekend of public comments from this guy, who is, of course, no longer the CEO of FTX, but was at the helm when it collapsed spectacularly with an $8 billion hole in the balance sheet. Maxine Waters, who heads the House Financial Services Committee, wants to have a hearing on all of this on the 13th of December. Now, she sent, at least in my estimation, a very odd tweet over the weekend in which she praised Sam Bankman-Fried for being transparent in his public comments, and he hoped that they could help in retrieving some lost customer money. I don't think she'd find a single soul on the planet who agrees with that assessment, but nonetheless, that's what she said. Mr. Bankman-Fried replied and said that he would be happy to testify before Congress. He would see it as his duty, but he would have to get to the bottom of what happened first, and he may not be able to make the December 13th deadline. That might tell you everything you need to know about the absurdity of this entire situation, JD. When Congress calls you to testify, you don't say, well, I might or I might not, or I may not be ready in that time. You say, yes, ma'am, I'll be there, I'll wear a shirt and tie, and I'll tell you the truth. And until he does that, he's going to, it's a long way away from him being able to engender any kind of trust with the public until he's able to do exactly that.
Yeah, it was stunning to me. He made comments to George Stephanopoulos where Stephanopoulos basically said, Sam, I'm twice the age you are. What do you want to be doing when you're 60? And one of his answers basically, I would like to figure out a way to make this whole. I want to make this right by everybody that I've wronged. I don't know what that process looks like. And he may not talk to Congress, but my goodness, Martin, he's certainly talking to a lot of other people. I know journalists are thankful for his willingness to do so. The great Martin Baccardax, thanks a lot for taking the time. I'm looking forward to getting to do this with you for another week, my friend. Have a great rest of your day.
Great. Thanks, JD.
All right, folks, that's going to do it for the Market Open here from the floor of the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.